to the DCB Bank Q4 FY26 earnings conference call hosted by Adfactors PR. Joining on the call is the senior leadership team of DCB Bank, Mr. Praveen Kutty, Managing Director and CEO, Mr. Sridhar Sheshadri, Whole-Time Director, Mr. Ravi Kumar, Chief Financial Officer, Mr. Ajit Kumar Singh, Chief Investor Relations Officer. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Praveen Kutty, Managing Director and CEO from DCB Bank. Thank you, and over to you, sir.
Thank you, Yusuf. Good evening, ladies and gentlemen. Welcome to DCB Bank's Q4 earnings call. In line with what we said before, consistency, predictability, repeatability are very critical to us. This is the 8th successive quarter I've been presenting the results, and I'm happy to say that the bank continues to grow in line with the stated milestones and the objectives that we have articulated in the last 2 years. Bottom line first, the profit after tax for Q4 is at 206 crores and the full year is at 732 crores, both of which are the highest ever in the history of the bank. This is the third successive quarter of registering highest quarterly profit, underlying the inherent consistency of our output. The bottom line is keeping pace with the top line, and the operating jaws are widening. 16% income growth, 11% expense growth, full year operating profit 25%, which is the highest in the last 8 years. You'll be hearing the sentence quite a lot in the next 10 minutes of my opening speech. In Q4, advances have grown by 18% on a year-on-year basis and 6% in the sequential quarter. Deposits have grown by 21% on a YOY basis and 7% in sequential quarter. We continue to ensure that the deposit growth outpaces the advances growth. The good part of the deposit growth is that the granularity of the portfolio continues to improve. Top 20 ratios well under 7%, 655 against 661 in the previous year. Further, this growth is coming at lower costs. Cost of deposit in Q4 is 44 basis points lower this year as compared to Q4 of last year. The advances growth is coming from chosen products, which is secured, small ticket, and granular. Mortgage, corporate, gold loan, agri, tractors, KCC, construction finance, educational institutional loans have contributed heavily to this particular growth. I want to take you through some of the commitments made in the beginning of the year. One of which was that we said that the co-lending book at the end of the year would be less than 15%. It is at 13.9%. Actually, the co-lending book has decreased in absolute terms between Q3 end and Q4 end. On net interest margin, the uptick continues. 3.39%, which we record in Q4, is 12 basis points higher than the sequential quarter and 10 basis points higher than the previous period, in the same period last year. Remember, we also had a 25 basis point rate cuts full impact happening in Q4. Treasury had a very muted quarter as far as fees was concerned, as expected, but our third-party distribution and other fee avenues demonstrated a fairly healthy growth, resulting in a core fee income growth of 198 crores, which is the highest ever in the history of the bank. Gross NPA, coming to the portfolio quality, is at 2.45. Net NPA is at 0.89, both of which are at 7-year lows. Our full year credit cost is 40 basis points. I want to hark back to the Q1 guidance in which I said we had a 59 basis points credit cost in Q1, and I had assured that there is no way we're going to be higher than 45 basis points credit cost for the year, and we clocked in 40. Our upgrades and recoveries during this quarter was 109% of fresh slippage. Our absolute gross NPA of 1,496 crores at the end of the year is lower than what it was in the beginning of the year. This is all about the output. What gives us confidence going forward is that the slippage ratio is 2.28%, down from 3.09%. And that can only augur well for the future as far as the portfolio quality is concerned. We continue to improve our cost to average assets. Our cost to average assets is, for the full year, is 2.5%. Despite taking what we took last in Q3, 27 crores because of the new wage code. And for Q4, the cost to average assets is 2.47. Our cost to income ratio has decreased by 300 basis points last year compared to this year. In November, during our Investor Day, many of you were kind enough to attend. We had reiterated quite a lot of things. We reiterated our stance of changing our mortgage mix of home loan and business loan, improving our average ticket size, increasing direct sourcing vis-a-vis DSA. We see the benefits of these flowing in. Our employee productivity is historically the highest. Our OPEX cost increases are marginal. Remember, 16% growth in incomes, 11% growth in expenses, widening jaws. We've been able to drop moderately on the yield and advances due to the rate cuts, to a certain extent by the gains on yield on account of the mix change. Over the year, Q4 of last year was Q4 of this year, the yield and advances has decreased by 56 basis points, despite we having a 100 basis point rate cut applicable for this financial year. In Q4, our ROA is 0.97 and our ROE is 13.53%. The full year ROE is 12.77, the highest in the last 11 years. In fact, it's the highest ever since the bank became a full tax-paying entity. That's all in the past. On a go-forward basis, the fundamentals of business are that we have sowed and harvested for several years, continuing to bring in consistent, predictable, repeatable outcomes. We're confident that it should continue in the future as well. There are clouds on the horizon on account of West Asia crisis. We're being cautious. We have overstocked on our liquidity. We have done detailed assessment and we don't see any immediate impact on the portfolio performance. But again, it depends upon how long this imbroglio lasts. That's it. Now I'll leave the floor open for questions or clarifications. Operator, could you come in, please?
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Akshat Agarwal from Swift Institutional Research. Please go ahead.
Good evening, sir. Thanks for the opportunity and congrats on a good set of numbers. My first question is on margins. NIMs have continued their robust upward trajectory, and previously had guided for benefits from the deposit repricing to continue until Q2. So if you can get some color on the repricing benefit which is still pending, and how is the bank progressing on HL to BL incremental sourcing? Is it still 60-40?
See, we expect the deposit repricing benefit to come till late Q2, perhaps early Q3. That's it, not beyond that. Okay? So that's the answer to your first question. HL to BL is much more than that. It's like we are almost 70-30, and that's really helping us. It's helping us in terms of yield. It is helping us in terms of credit cost, and the fact that we have also gone slightly higher ticket size has helped the cost consistently, and that possibly is reflecting in the new slippages coming down from 3.09 to 2.28. It's certainly a part contributor to that.
Right, sir. In terms of asset quality, which continues to be very strong, do you expect this trend to sustain, or should we anticipate normalization towards your through the cycle guidance of 45 to 55 bps, the business model guidance, barring this West Asia conflict?
See, as of now, we're sticking to the 40, below 45 bps. Okay, we don't see credit. See, currently we are at 32, 33 bps. See, I don't see us in the short term increasing anywhere around the 45 basis points mark, and our model continues to be 45 to 55. So fairly strong on that, and I would expect a similar trend to continue. There's no reason to believe that in the short term we would have any reversal coming through.
Very well, sir. In terms of fee growth, which has been very strong for many quarters now, and with the latest quarter at 9% QOQ, what are the key drivers for this quarter, and how should we see sustainability going forward? Is it still third-party distribution, or is there some other drivers? So if you can help with some color, sir. Thank you.
It's the same. See, the leopard never changes spots. We are like that. We don't. Nothing happens all of a sudden. So we continue to be high on third-party distribution. Forex income is decent. Trade is an area of concentration. The repeatability of income is something which we are focusing on. Treasury gave us nothing in Q4, nothing. And we expect that trend possibly to continue. So core fee income is a key driver for fee going forward.
Right, sir. And my last question is on branch expansion and headcount. So what's your outlook going forward? I understand you added 11 branches in 4Q and employees around 400 on net basis. So how should we think about investments on this front going forward?
See, if you see the number of employees, you see a U-shape coming through. So if you were to see the number of employees that we have in, let me get the year right, 24 end, you see that, or rather September of 2024, we had 11,900 people. We still are lower than that, but I expect us to hit a 13,000 kind of number by the end of this particular year. We're still a people-driven business. A lot of our sales are assisted sales, so there will be more people coming in. Branches are optional. We don't necessarily need to have more branches to grow. People are required. But having said that, there is a very high probability that we'll cross the 500 branch barrier, or rather mark, during this year.
Very well, sir. Thank you very much for answering all my questions. All the best.
Thank you.
Thank you. Next question is from the line of Parth M. Gutka from 361 Capital. Please proceed.
Yeah. Hi, sir. Thanks a lot for the opportunity. So my first question is on the day.
Sorry to interrupt, Mr. Parth. Your voice is breaking.
I'm so sorry. I don't know whether you can hear me, but we just can't hear you.
Mr. Parth?
Yeah. Can you hear me now?
Yes, we can hear you now. Please proceed.
Yeah. Okay. So my question was in March. If I look at your yield on advances, it's flat quarter on quarter. cost of funds have declined slightly. The liquidity on the balance sheet has, gone up quarter on quarter. So ideally margins should have been, not improved by 12 bits or should have improved marginally, is what the calculation suggests. So are there any one-offs in the margins?
No, there are no one-offs in the margins. We're not a one-off business. You can't be in a retail environment and have one-offs. What you could have is queues at the month end. The liquidity build-up could be towards the end rather than the other way around. One of the key factors in NIM is the quality of portfolio. If you recover 109% of your fresh slippage, it is bound to have an impact not only on the NNPA and the GNPA, but also on your NIM.
Okay, fair enough. Okay. And my second question was on the cost to assets, considering for the full year we are at around 2.45. What is the...
For the full year we are at 2.5. For the quarter we are 2.4.
Okay. So what is the further juice left here, or what will lead to the further improvement of cost to assets from here on, or it will be stable at around these levels?
See, it is a bit like the earlier question which was asked on credit cost. Model suggests 45 bits to 55 bits of credit cost. Model suggests 2.5% of cost to average assets. Reality, we are slightly better than that. We're very happy at 2.5. And remember, there is going to be an increase in the number of people, which will also result in more productivity. We've already been one, so there will be a linear increase through the year of number of people. So
okay.
Those investments are critical, and despite that, we are reasonably confident of a 2.5% cost to average going through.
Okay, perfect. Okay, and just one last question, if I can squeeze in. So because the war was persisting, large part of the March month, have you tweaked any of your risk filters while sanctioning and disbursements to your MSME customers?
I think we were lucky more than we never predicted this, but going up the ladder of ticket size, it was meant to be an operation productivity exercise that has resulted in lower bounces. We sacrificed a bit of a yield, but we're getting better quality customers, and that's reflecting in fresh slippages being better. And all these things happened much before the war actually manifested. So now, see, if this continues, it will affect everybody, but people at the lower end of the economic pyramid will get impacted more. So there's not a specific problem we'll have. If hydrocarbon prices go up, everyone is going to get affected. And the effect will be largely felt by people who do not have the security of or a cushion to take care of this extra expense will hit their monthly bills. So I would tend to think that reprofiling and going up the ticket size about a year and a half back is helping us compared to where we would have been had we not moved the needle. But there's not a reaction to the war at all. It just so happened that it helps us that we've done these things much beforehand.
Sure, sir. Thanks a lot, sir.
You're welcome.
Thank you. Next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Savin, hi. Just two questions from my side. When you speak to your collection teams and when they are reporting such strong numbers, would you ascribe this on the ground that their leverage levels of the borrowers have come down, their access to credit has improved? What is the general feedback as to what constitutes a better recovery? Number one. Second one is that if assuming that we are into this slowdown and there is a slowdown in the next 6 to 9 months, would you say that the book today is better than where it was in 2023 when we had the slowdown led by unsecured loans and MFI, or would you say that the book is broadly the same?
I think, let me answer your first question first. So what has really happened is, if you were there in the Investor Day presentation, I made the statement saying that we moved from managing NPA to managing one DPD, as in 1 days past due. Okay, and when we made the statement, we already implemented that. So we did put in more people. We significantly improved our early bucket collection. The intensities increased significantly. And what you see in March is the result of those activities which we did in somewhere around June, July, and then persisted with it. That's the way I see it. So it's more of intensity. It is more of more of focus in the earlier buckets, which we were not really focused upon. Otherwise, your slippage ratio would never have come down. I mean, you could have any kind of recovery, 109% recovery, which will help the NNPA most certainly, but that will not help the slippage. One particular metric you can look at is, for the first time we've given slippages of gold loans separately, okay, in the investor presentation. Now that clearly is an indicator of the pressure in the market, because we don't do early bucket collection in gold loan. It's not worth our while, right? Because the gold is there. Why call on the 30th day, and that's an operational cost. So there's a natural delinquency which we see on the gold loan, and I would tend to imagine that as a reasonably good barometer for the pain at the lower end of the pyramid. And if you were to look at that page number, I think it is 26. Okay, the bottom left-hand corner, you can see there's marginal improvement. I'll just read out the number for those people who haven't seen this. It used to be 6.29 a year back. Now it is 5.3. And this is natural repayment or natural slippage which really happens. The real action happens near NPA rather than in the beginning.
Perfect. Thank you. And to the question that you're saying with respect to the portfolio that you're carrying today versus where you were probably about 2 years back.
See, 2 years back, our credit cost was in the region of 0.3, somewhere between 0.38 and 0.42. Currently, we are at 0.4. So what we've done is we have ridden the wave. So if history were to repeat, we will also repeat the particular performance. So you see marginal increase in our credit cost, still will be below 45 bips. But there's a very strange statement to make, because if freight prices were to shoot up post, you could see a situation whereby inflation really is impacted. Second order issues of petrochemical oriented products not coming to the market could keep the supply chain inefficient. So it is not just about inflation alone. It's about, everybody's impacted. And unlike COVID, you can't do quantitative easing and get out of this. You will have to, and it's not going to be that easy. So, but at the moment, it's good to be in a position where your slippage ratios are lower, where your NNPAs are lower, your recoveries are higher. It's a good place to be in.
So just to clarify, in your assessment, when you are looking at those borrowers, are you saying are you seeing a situation where those borrowers' leverage levels is similar to where they were 2 years back, or they are better or worse off? What's your assessment of the customers that are coming to the fold?
So the reason I'm not able to give you a straight answer is the customers' stock which we had 2 years back is very different from the customer stock that we're having today, because over the last 2 years, the kind of ticket size of customers that we have onboarded, the kind of profile of customers that we have onboarded are different. Our MFI book has dramatically come down. At one point in time, it was 1,400 crore book. Now it is some 600, 700? Yeah, 600, 700 odd crore book. So it's not the same. I mean, while the balance sheet has grown by 20%, the customer advances have grown by about 18%. The fact remains that they're not that comparable.
Perfect. Thank you, sir. Thank you for this. Yeah.
You're welcome.
Thank you. Next question is from the line of Rohan M. from Equirus Securities. Please proceed.
Good evening, sir. Thanks for the opportunity. Congrats on good set of numbers.
Thank you very much.
This is on the yields. Yields are flattish Q on Q. And what we had explained earlier in the conferences, our book on the mortgage especially, is fixed to floating when we see gradual repricing over some period. So with repo cuts happening, what has helped us sustain yields at this level, especially with corporate disbursements also picking up? So have we taken any increase in spreads on incremental lending, or what has helped that, if you can explain that?
Yeah. So frankly, if you see, our co-lending book has come down. Co-lending book is a low yield book. It comes at low cost but low yield. So this is a product mix game. So if you see, we have grown 6% quarter on quarter sequentially, and our co-lending book has degrown. So the low yielding book has degrown, and higher yielding book have grown, which has resulted in incremental yield being higher, and it has absorbed the 25 bips repo rate cut, the full impact of which we had in Q4.
Sure, sir. So secondly, if you look at slippages ex gold, it has fallen to 1.5%.
1.47.
1.47. So just want to get a sense, like, given how the macro is evolving right now, and there's uncertainty on how things will shape up, given your interaction with the clients, like, is this sustainable going into FY27, and especially with negative net slippages, if can this trend continue in FY27?
Very difficult to answer because there's so many unpredictable, unponderables there. But what you see day one is very different from what you see on day two, right? There is so much of change happening, which is which makes prediction really, really very difficult. But what I'm confident of is that I don't see our net NPA going back above 1%. We said that, I don't know if you remember in the Q3 call, I said we will be below 1%. We are there, and we intend to stay there. Like I said in the opening remark, the benefit is coming through lower slippage, higher focus on the early buckets. But if an SME customer does not get the component that he wants to complete his product, he will suffer, and along with him, we also will suffer. We are aware of that. So far, we are not seeing that happening. But that is not a guarantee for the future.
Sure. And so lastly, what will drive your NIMs towards your business model NIMs target of 350 to 365? And what is your time frame expectations around that?
See, if there is one thing I'm not happy in a very decent quarter, or a decent year for the matter, is there are so many things which are good. One thing which I'm not very happy about is the current account pickup. So we are focused on it. We want to. Our SA growth is 10%. Our CA growth is flat, and that's not a good thing to happen. We're putting resources behind it. We're putting effort behind it. We're putting focus behind it. That has to improve. And now and practically everything that we put focus on, you see an improvement happening. It's time it happens in the current account portfolio as well. So that's one big driver. We've really moved the needle on engagement with our savings customers. There is a whole host of cross-sell activities happening on our asset customer base. It's still a snowball. It hasn't reached avalanche, but sustained efforts over a period of time. Retail was that way. The good work that we had done about a year and a half back, you're seeing the result of it now. So we are at it. We just keep progressing on the right path. Trust the process, and the results will happen.
Sure, sir. So thanks for the opportunity.
You're welcome.
Thank you. Next question is from the line of Jay Mundra from ICICI Securities. Please go ahead.
Yeah, hi, good evening, Praveen. Thanks for the opportunity. Hi. Sir, I have a few questions. One is, if I look at your slippages number, right? So just a broad calculation, overall slippages are 2.28, excluding growth. Gold is 1.47, and gold is 5% roughly. I mean, the number somehow does not tally in the sense that gold is supposedly less than, if I do the reverse calculation, it looks like gold is 20% of the portfolio to drive that change from 2.28 to 1.47. These are gross slippages number only, right? So that is why I'm assuming these are gross slippages, 1.47 and 5% of gold.
That's right. These are actual numbers. I can put you onto my finance folks or a collection folks and can have a discussion on that. Can take you through the numbers. These are 2.28 is our slippage. It's come down from 3.09.
Okay. So that is anyway. So I'll take that offline. Second is, sir, on the growth front, right? So we have done 18% growth, which is much faster than the industry. But somehow, as you also mentioned in the opening remarks, the co-lending has declined QOQ, and rightly you had highlighted at the beginning of the year also that at some point of time it will moderate. But the growth of the core businesses like mortgage, 10-11%, MSME flat or negative. How, and as you said, co-lending, I believe this co-lending is a function of CLM transition. So how should we look at the next year going ahead when, mortgage is 10-11% and MSME is still yet to pick up? So far the growth has been coming from...
Let's look at that. It's a good question, and I'm sure my answer will help a lot of people in this call. Kindly look at quarter. Okay? Look at the quarter and look at the mortgage growth in the quarter. You want me to tell you the page number?
Yes, 3.8%. Yeah.
Okay. For sake of argument, let's say 4%. Okay.
Yeah.
And if you have to multiply by 4, you're talking about 16. So what you've seen is while the bank has grown 18% in this year, 24% the last year, we have been busy re-engineering the mortgage business. Okay. We have really turned it around because that is contributing to delinquencies. It is a lower ticket issue which was vulnerable. So we have really changed the wheels of the train while the train is still moving, and you haven't felt it because other products contributed to that particular growth. Now what's happening is a better BLHL skew, a better self-sourced versus DSA-sourced mortgage is up and running. And every quarter that growth is better than the previous Q-on-Q growth. So what you've seen, the 10% of growth that you saw in the year, I would look at it slightly differently and say 6.5% was a growth in the first 9 months, and 3.5% is a growth in one single quarter. And the 3.5% of the mortgage book that we're growing in the quarter is of a supremely better quality than the kind of book that we had a year back. Are you with me? Hello?
Yes, sir. This part is understood. Yes.
So clearly there is a takeoff happening on that count. So my finance folks have just come in with some broad math. Can I go to the earlier question?
Sure, sir.
All right. Vishal, you want to explain this?
Yeah. Gold have a weightage of 21% and a slippage of 5.3%. And other than gold have a weightage of 79% and a slippage of 1.4%. So overall, it's coming to 0.38% at bank.
Correct. No, sir, you are right. If the gold weightage is 20%, then the math is absolutely right. But just
it's 21.21%. So that covers the discussion. Okay. So that's the second question. Now, can I ask you a question, Jay?
Yeah, please, sir.
Do you remember in the investor day, we were standing outside, and then you told me at that time our NNPA was 1.22%, and you told me for a business of our type, you remove the 22 basis points from the ROA. Do you remember the conversation?
Yes, I do, sir.
Okay, I want to tell you, you don't have to do that anymore. We are at 89 basis.
Yeah. And congratulations, sir. Yes.
No. Once again, I want you to know that, and thank you for it, because this kind of conversation, I want to let you know, helps us also. So now we're at 89 bits. So I just want to tell you that there are not promises. The intentions that we say, we take it extremely seriously, and we demonstrate it by the performance. And you'll see that coming through in the next few quarters as well.
Right, sir. Well appreciated, sir. Yes.
Right.
Okay. No, sir, sorry, just to come back, so gold loan proportion is 20-21%, but in this table, the advances makes the gold loan proportion looks like 7-8%. So I believe the co-lending plus gold plus it is also sitting somewhere.
Absolutely. See, co-lending, we have about 8,300 crores, 8,366 crores of co-lending, bulk of which is gold, and then you have normal gold, our own gold of about 4,000 odd crores.
Right. Okay, sure. And sir, then going ahead, so mortgage, I take your point, sir, that mortgage has accelerated and maybe it will sustain. But if the other piece, so far this quarter the growth has also been contributed by corporates and MFI institution, which may or may not be desirable, or you can still sustain. But I'm saying that in case of co-lending not being a meaningful contributor to the growth, which portion will do the heavy lifting apart from mortgage?
So I want to repeat what I said earlier. Consistently been saying throughout. We had, and I will tell you this, our co-lending growth in 24-25, it is not in this book, but if you have to look at the previous book, was 108%. 108%. This year, it is 24.9%. That is 25-26. In the current year, 26-27, I'm not telling you the percentage, but it will be exactly the same as the overall asset growth of the bank. Are you with me? 108 has been brought down to 24.9. And in the current year, 27-28, 26-27, we will be co-lending growth will be exactly similar to the overall asset growth of the bank. So that's one part of it. It will not be zero, and it's not even advisable, right? So that will be the steady normal growth happening there. You will have growth coming in from the mortgages. And there are some impact players like SME, MSME, and construction finance, where a lot of effort has gone into it. The output is yet to come, but it will not remain like that forever. So we'll see contribution coming in from these core segments. The agri segment, I don't know how fertilizer prices will be affected by this, this West Asia crisis, but assume that life is normal. I would tend to think that tractors, KCC growth will happen. I'm not a big fan of MFI. We do MFI only to meet the small farmer, marginal farmer requirement. It's not meant for balance sheet growth, or you have to do it. Right? The history has not proved very, very good either for us or the industry. But yeah, so it will be the MFI growth, the BC MFI growth will be sufficient to meet our small farmer, marginal farmer appetite. So that's the way we see this. So I do the math. 6% is a quarter-on-quarter growth. You remove co-lending, it comes to 8.6% non-co-lending growth. 8 points, I'm not saying 8.6 into 4. I wish I could say that. My senior leadership team also sitting here. Just imagine 8.6 into 4. then I could be leaving home at 4 o'clock every day.
Right. And sir, any guidance, or I mean, you would, I think in the analyst day you had said that this 18-20% kind of a growth we should be delivering over the next. I mean, that still remains the broad guidance, right? In terms of
I mean, in these times when there are clouds, etc., on the horizon, 18, we are cautious. We're very, very. We only know the pains of getting 1.22% NNPA to 0.89. Our team is fully aware of the pain of getting a 3.32% gross NPA 8 quarters back to 2.45. So these are hard, not to talk about slippage. So these are hard-earned lessons. So we're very confident about growth, what kind of growth that we want, and we think we're fairly on a good track as far as the portfolio is concerned.
Right. And last question, sir, on co-lending CLM change. Correct me. My understanding is that it has now changed from discretionary to non-discretionary, and which is why you may have some disruption in the March quarter. Has that been sorted already, or you believe there could be some more teething issues when you align towards the new guidelines? And
one good thing about the bank, Jay, one good thing about the bank is the quality of tech. Okay, I mean that is one really good thing that we have. So, but that doesn't guarantee everything, because partners' tech also should be up to gear. We acted pretty much early, around September, October on this, and we got it absolutely right. Some of the big gold loan players are our partners, and it's working very well, very, very well with them. And probably since we're all in the financial industry, you'll be covering them also. I invite you to even speak to them and figure out how this particular thing is progressing. We are very comfortable with them. They are very comfortable with us. And I'm sure some of these guys are part of your coverage.
Right. No, sir, just coming back to the question, is that disruption, the transition is over, and even incrementally, I mean, you said that co-lending will be growing as much as the overall growth. So I would believe that the entire transition is over, right? And there is no more.
Yes. For us, why I'm not giving you a straight answer on that is, it is over for gold. It is not over for. We do educational institution financing. We do that is school financing. We do LAP. We keep doing various things. So, so in areas of little volume consequences, we are a bit slow. So at a bank level, is it done? Fully no. But as far as our gold loan is concerned, which is our lion's share of our co-lending, we are very comfortable. And the reason why gold loan is a lion's share of co-lending is because you can accurately predict the loss.
Correct. And does this change anything, sir, structurally? I mean, the transition. One is, I believe you may not have a discretion in terms of how you partner with the partner. Is there anything also changes or not material?
We had this partnership, Jay, okay, with one of our partners from 2022. Okay, that partner was our single largest partner until February of 2024.
Right.
Then we had a second big partner coming through. So we are talking about 4-year history. We are talking about 2-year history, and there is it's like a full-fledged. I mean, I can do a PhD on co-lending, gold co-lending at least, right? So that these are kind of relationships and partnerships that we have for the co-lending part. So I don't see any disruption coming in. Sorry.
And lastly, sir, if I may ask, why is there a seasonality in the fourth quarter? I mean, is this a normal seasonality in terms of lower slippages, higher recovery, or there is something more fundamental in the product that we have? I mean, all banks have seasonality, which is favorable seasonality in 4Q, but for our case, it looks slightly more pronounced. So any Any reason, or it's like business as usual things? Thank you.
Our appraisal is in April. I can't think of any reason, Jay. Sorry.
Okay. No issue, sir. Thank you and all the very good, sir. Yeah. Thank you.
Thank you. Next question is from the line of Aditya from Securities Investment Management. Please proceed.
Hi, sir. Thanks for the opportunity and congratulations on the set of results. Hi, sir.
Thank you very much.
Sir, my first question was on NIMs. So how should we see the NIM trajectory now from here on? So do you see them still improving? Because while your deposits are still getting repriced, but your CASA share has been reducing, rates industry-wide have been hardening, and also your reliance on bulk deposits have been increasing. It is now 20% of your deposits. So how do you see the NIMs for the bank going forward?
I wanted to focus on cost of deposit because the ultimate truth, which is a mixture of the CASA, institutional deposits, excess liquidity that we keep for a rainy day, all that is reflected in cost of deposit. Right. So have a look at the trend line of the cost of deposit. Our belief is that if you were to renew as much as we renew normally, we should be having some advantage going all the way into Q2. After that, the advantage will stop. But that's only part of the story. In the Investor Day, I had mentioned this, and this is public information. Just do this. Look at the peak retail term deposit rate of 3 of the biggest private sector banks and 3 of the biggest public sector banks, and come with the composite peak retail term deposit rate. Compare that with DCB banks and see how convergence is happening. This number, the difference between the composite rate of the 6 largest banks in India and us, at one point in time was about 1.27. It was 0.89, if I remember right, in March. It's there in my Investor Day presentation. The 0.89. We brought it down to something like 0.60 or 61. 0.61, and it's publicly available. Why we're not doing this bulk deposit is I'm not aware, because many banks don't publish that. We do. Right, so that is slightly unequal. But this is an indication. One is of longer tenor deposit maturity, and you're having a benefit of renewal repricing. The second is even fresh deposit. This bank used to be a bank which was in the top 3 of highest interest rate. Please look at the website of similar sized banks. We are no longer there. The bank has learned to sell liability products on items other than price also. Price is still a big component. I mean, we're not anywhere where we need to be. But the reason why people bank with you, earlier used to be the rate. Today, it is changing. And it's been hard work for the last 1.5 years. Our branch bank team has done a fantastic job of switching it. And the proof of the pudding is look at the website. Look at the website and find out. I don't want to name banks now. We've grown 20.91%. Look at our rates. Look at similar size, even bigger sized banks. If you're not lower than them, the distance between the two has dropped. So that's how we are seeing it. And like I told another gentleman earlier, we're really working hard on getting our story on current account right. Effort has gone into it. Results have not come in yet. But we're not people who give up easily.
Understood. But now, sir, I understand that we have been more aggressive in cutting rates as compared to other banks. But now, when I look at the deposit growth, so that is majorly being coming from bulk deposits. Our retail deposits have not been keeping up pace with the overall deposit growth. So how do you see that going forward?
For us, there are 2 things which really matter in the order of priority. We should be liquid. Being liquid is not a choice. So that pure play liquidity is important. cost of deposit is important, long tenure is important. Now, if you meet these conditions, frankly, if it is it a SA coming in, really doesn't matter. There was a time when the bank used to give 8% rate on savings account. Today, I think it gives 6.7%. Okay, that's a rate that the bank gives. That's why I said it's easy to grow bulk SA and show a better CASA ratio. We prefer to grow deposits and keep the cost of deposit down. Whereas CA is an equal story. You can compare CA across banks. SA comparing doesn't really make sense because some of the SA are actually more expensive. Well, like one day you can put money into savings account and get in our bank itself 6.7%. So it's really expensive. But it helps in terms of saying publicly CASA ratio is good. I would tend to think you should look CA and SA separately. Look at while we don't publish it, our SA weighted average pricing on a SA has come down significantly. I mean, if 25 basis point rate cut happened and we have reduced our cost of deposit in Q4, which is a traditionally very liability hungry market, it comes because we are getting the right kind of deposit.
And just last bit on this deposit part. Now, DCB is generally known for being focused on granularity, either being on advances or on deposits. Now, bulk deposits is currently 20%. So, is there any percentage beyond which you won't be comfortable growing bulk deposits?
Like I told you, we have to ensure that if you get a bulk deposit which is of a lower rate of interest, earlier we were giving it up, but now we are managing three things. We are managing granularity, we are managing ROI, and we are also managing the tenor. So it is an uneven battle. We triangulate these three things. Earlier we used to take a stance saying that even if the rates are lower, we will not take bulk because it doesn't meet our small ticket criteria. But in a time like now when there is chaos, liquidity is important for us. So it is good to have extra liquidity, even if it means there is a higher carrying cost. So we do have bulk deposit. Do we have a number on retail term deposit? Yes, of course. We have to grow that. We want to grow that. But this is a good buffer to keeping your cost of deposit down.
Sure, sir. Understood. And sir, on your ROA, so for the ROA to improve from here, I believe NIMs would be the major lever for us to grow because the credit costs and OPEX costs are pretty much under control. And for the NIMs to improve from here, would cost of deposits be the only trigger for us to improve on NIMs?
Yes. We don't want to go into a higher yield segment, because this is not really the time to go to a high yield segment. It comes to sting in the tail. So improvements will come because we're keeping a tighter rein on the cost of deposit.
Got it. And also on this SME book, this 2,000 crores book, so how big is the trades part? Because we were looking to degrow that part of the book. And how is the book, apart from trades, growing for us, the CCOD part?
It's not growing. So that's why I said we are putting some effort into it. It's not growing. It is stuck where it is. If I see it's a flat kind of thing, quarter on quarter. It has decreased by about 13% year on year. So we are kind of revamping that. We got a new vertical to look at the greater than 3 crore. There's a lot of good customers who are above a particular threshold, 3 crores, were leaving the bank because it's meant to be a small ticket program. We said, look, that doesn't make any sense. So you're just filling up the bank. So we have got a new, no longer from July onwards we've been having this channel. It is just getting set and ready. So that's where the momentum we see happening. The SME comeback will happen. Treads is about 300 crore book, so hardly any. It used to be 300, it continues to be 300, so there's no change.
Understood. And so just last question, what is the bank's now position on fundraising? We have got an enabling provision for fundraising. So how is the bank looking?
We should be in the next two 3 quarters, next 2 quarters maybe, right? Maybe either late Q2 or early Q3. We should be going in for a fundraise because we see that as a bank we will be continue to grow at this kind of pace, and if we do continue to grow at this kind of pace with a similar kind of portfolio mix, probably we'll reach our internal red flag by Q1 of 27-28. We don't want to wait that long, so maybe Q2 and Q3 beginning. Somewhere in that.
Sure. Thanks, sir, for answering the questions.
Not at all.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address the question from all the participants in the conference, please restrict yourself to 2 questions per participant. Should you have a follow-up questions, please rejoin the queue. Next question is from the line of Param Subramaniam from Investec. Please proceed.
Yeah, hi. Thanks for taking my question and congrats on the quarter. Yeah. So, firstly, on the board enabling resolution for the capital raise. So, is that an enabling? Is it just procedural, or are we looking at something? And 1,500 crores seems the largest number there.
Yeah, maybe I'd be happy with something like somewhere between 1,100-1,200 crore.
Okay.
So it's good to keep some 1,500 crore enabling resolution done. But $100 million, not slightly more, maybe somewhere in that particular region. See, the thought process behind it is simple. Take what you need right now at the price prevailing at this particular point in time. Our belief is that if we continue performing like this, the next raise will be at a different level. So don't over dilute at this point in time. Just do what is required to continue this particular growth momentum. And then when the next level of expansion happens hopefully soon, we'll be raising again at a slightly different level with the fundamental numbers looking even better than what is looking today. That's what is driving the management thought process.
Perfect. I mean, makes a lot of sense. Secondly, on your provision coverage ratio, I mean, this quarter it's gone up sharply. What level are we broadly comfortable with?
78 plus is good, and as a company we like to keep those provisions, but anything above 75 is okay. But if you remember, we have some MFI loans had gone bad in the last year, Q1, Q2, etc. So we want to ensure that the aging provision of that should not stutter us. So we have kind of sufficiently ensured provisioning in these unsecured, small ticket, microfinance kind of loans of Q1, so that there is some evenness in the way things will happen going forward.
Got it. And lastly, this is just so on the quarter. So your NIM is up 12 basis points, right? Now, is there some day count or something impacting that? Because your NII is broadly in line with your loan growth and your asset growth, right? So 12 basis point uptick. I'm just trying to reconcile with the quarter-on-quarter 5% NII growth.
See, what I look at is instead of worrying about day count, I just compare us with Q4 of last year. Last year Q4 we were 3.29. Neither was last year a leap year, nor is this year a leap year. I think so. So you're talking about similar kind of days. So if you're having 10 bips improvement on NIM, despite having a 100 basis point repo rate cut impact, not doing too badly.
I was looking at the quarter-on-quarter sort of movement.
Yeah, quarter-on-quarter.
12 basis point, right? The NIM is up 12 basis point, but
yeah. So I would tend to think, I always look at Jan, Feb, March, or the Jan, Feb, March, and April, May, June, so that in case there are any abnormalities of number of days coming into play, comparison with similar kind of time frame the previous year is a good indicator, are we making progress or not.
Perfect. That's all I had. Congratulations on the quarter once again. Thank you.
Thank you very much.
Thank you. Next question is from the line of Akshay Badlani from HDFC Securities. Please proceed.
Yeah, hi. Thank you for taking my question.
Hi, Akshay. How are you?
Hi, I'm good. Thank you. So Praveen, just wanted to ask you mentioned of increasing employees headcount to 13,000 from current, so it would be
around 13,000 from current levels.
Yeah, so 1,500 addition for the next year. So just wanted to understand in which areas are you looking to add on, and how would we ensure that our cost to income, the trend that has been there and we have maintained reducing our cost to income, how would we ensure that in spite of adding employees that we will maintain that run rate? Yeah, because we haven't added employees in last year or so. Yeah, apart from this.
I know we haven't. We kept on adding, and we kept on getting rid. So it is not as if we never added. Our exit process also was really sharp and good. But where I see this coming in is it's not for this year. We see practically all these folks going into the liability and deposit acquisition. So we'll put more people in the branches. We'll put more people on the distribution front. I realize the basic math tells us that between a self-sourcing sales network on mortgages and a DSA dependent sourcing, initially you may feel that 2% or 2.5% to the DSA is cheaper. But we've seen that the loan sticks with you for 2 years, 2.5 years, whereas self-sourcing loans stick with you for 6, 7, higher than 6 years. You're getting the benefit coming through. The BTs, the balance takeouts are considerably less. You own the customer, not somebody else. And the credit quality, of these loans are really better than what the DSA source loans are. They are a necessary. I'm trying to find another word for evil. They are a necessity. We can't live without them. But our dependence has to necessarily come down. So I don't mind putting in the people there because I'm very confident that the team has shown it to me that from a longevity perspective, from a balance BT out perspective, from a coupon perspective and a credit perspective, these customers over the currency of loan in our bank are far better quality than DSA. Whereas the basic math of 2.5% per ticket size with a 5 lakh salary of a sales executive may initially look like it's a bad call. It is not. I mean, if you know how to run the non-DSA channel.
Sure. My second question was on the line of cross-sell. So, at the analyst day, we had indicated of, around the DCB Neo cards where, we would like to cross-sell. And even in terms of liabilities like OD facility, we were wanting to offer. So what progress, what kind of progress have we made there?
I'm very, very happy to say that not a significant, a sizable chunk of the 3.8% Q-on-Q mortgage growth has come from the branch banking channel. Look, this is bread and butter for most companies. For us, it is not. So for us, there's a low-hanging fruit. It just kind of is kicking in. It should not be news at all. Honestly, this should have been the way things should happen. But anyway, let's not complain. So clearly that is coming through from the branch banking channel, less so from the digital channel. So that's one. our credit bureau linked interventions on our liability base is where these LAP loans and home loans are coming through. We're reasonably happy with that. I'm not particularly happy with the level of cross-sell that we have achieved so far. But again, that is not stopping us from trying. There is a pressure within. It is difficult. It's not an easy thing, but we are at it. It is giving us result. So, but I knew it will be a painfully slow process, but it is certainly a painfully slow process. But yeah, it is. Directionally, is it going okay? Yes. From a volume sense, it is a bit frustrating at times. But there's no choice. I have to keep at it, and we'll see the benefit of it coming through.
Sure. Thanks for answering my question.
Not at all.
Thank you. Next question is from the line of Puneet Balani from Dalat Capital. Please proceed.
Oh, hello, sir. Am I audible?
Oh, you're very much audible. Yes.
Yeah. So firstly, on the margin front, like this quarter, firstly, if you could explain where the 12 bps QOQ is coming from, and secondly, if you are looking at from a next year perspective, is it fair to assume that given that we have a lot of bulk deposits and yes, we are growing our mortgage book pretty well. Despite that, we will get some decline from funding costs. Like we can expect like margins to be range bound around these levels because of these two factors. Any comments on that?
It can happen. I mean, can it be range bound in this particular level? Possible. But like I told the gentleman earlier also, compare us quarter on quarter with the same quarter of the previous year. If it happens, it primarily will be a execution issue because our ability to get the liabilities at the cost that we want is a journey that we are taking, and we're very happy with the first 9 months of that progress. Our people have learned that you don't need to be the highest rate or one of the highest rate providers to get liabilities into the bank. So that I would see as a execution risk rather than a strategic risk. So it's worked very well so far. In Q4, if we can get that kind of volume and still keep the rates, not about the cost, the rates, the offered rates on the website lower than who we used to have, a margin, a difference with other banks who had a margin with. It's a good thing going. So there is an institutional resilience building on ability to get lower cost in deposit. No way are we near the big 6 or big 7, but we are not the bank that we were a year and a half back.
Right. And on the growth front, like I know you have mentioned in your presentation that in 3 to 4 years you aim to double the balance sheet. But given the fact that now you have the way you have highlighted that you had with the gold loan book, it is already at a decent base. The co-lending book, is it fair to assume that growth will be around these levels for the next couple of years or so, or you are targeting still the 20% level plus?
I think 18-20% is a given. I mean, you just look at our March 22 liability numbers and multiply by 2. You just multiply our March 22 asset numbers and see where we are.
Right.
29,800 was our asset number in March 22. Today you are 60,000.
Right.
You had your liability number was 35,000 or slightly 36,000. Yeah, 35,000 in March 22. Today you are at 72,000. So that's 4 years, and that a 4 year where 1 year they were recovering from, our bank was recovering from COVID. So getting up to speed. So in that tough times, and we can do that. We had a microfinance kind of problem hitting us, secured DA problem hitting us. Despite all this, we are managing both the credit quality and the growth. these things will happen, and that's why we are paid in the first place, right? To manage these imponderables. Something is going to hit you. You don't know what it is, and how well you manage that is the resilience of an institution.
Right. Okay. That's it from my side, sir. Thank you.
Oh, thank you very much.
Thank you. Ladies and gentlemen, we will take this as the last question for the day. I now hand the conference over to Mr. Praveen Kutty for the closing comments. Over to you, sir.
Thank you very much for your attention, and watch the space 90 days from now.
Thank you, sir. On behalf of DCB Bank, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.